as we head into 2023, we still see kind of a steady transaction volume. We looked at statistics going back through Q1 and Q2, and it did look like the number of transactions closing in Q2 was off somewhat. There were 55 transactions that closed in Q2 among the database that we sampled, and that compared to 93 in Q2 of last year. Some people are saying that that's a result of a breather from the torrid pace that was being done back in Q4 and Q1. So we'll see if that plays out or not. One of the interesting things, though, even though the number of deals came down a little bit, the actual multiples were holding steady. So we hadn't seen really any kind of a decrease in multiples or valuation metrics. At FourBridges here, we actually are fairly busy. We've got some transactions that are in the middle of being marketed or close to being closed, getting over the finish line here at year end. Buyers still seem to be interested. We're continuing to get plenty of folks asking inquiries about what's in our pipeline, and I think that's being driven by the amount of private equity capital that was raised during this year or the last couple of years. In 2021, there were 389 funds raised with about 301 billion in capital raised. And so there's a lot of dry powder that's still out there. This is capital that's available to be invested in privately held companies. At the end of 2019, the PitchBook estimated there was 1.7 billion. There was 1.9 billion at the end of 2020, and there's 2.1 billion at the end of 2021. What does that mean exactly, and how does that impact owners of businesses? A lot of it has to do with the structure of a private equity firm. In the first couple of years after a PE fund goes out and raises, say, a $500 million fund, they get a management fee typically of 2% of that capital as a management fee for the first couple of years. After that, it flips to being paid a percentage of capital that's been deployed. So they can't really go out and raise money and then just sit on it.
Certainly a recession, the impact on a potential seller would be driven primarily by what type of business they're in. We've got a couple of industries we're working in right now. One's been in the electrical control panel industry, and even though there's been some slowdown in some other sectors, that one's going pretty strong, primarily driven by the onshoring of manufacturing as people are continuing to de-risk the supply chain issues involved with Asia and bringing manufacturing back to the U.S. So companies that are involved in putting in new manufacturing lines and plant and equipment and those arenas seem to be benefiting, even as everybody is concerned about potential recessionary impacts. Companies that are in high quality and continue to weather the storm of a softness in the economy, we think that there'll still be a good pool of willing buyers. As everyone knows, the Fed has continued to raise interest rates in 2022, and we are seeing some impact in transactions. We hadn't really seemed to get much of an impact on the headline valuations yet. That'll remain to be seen over the next few months and quarters. What we have seen is that some of the lenders seem to have pulled in their horns on some of their underwriting structures, so that, for instance, we had one transaction where the buyer felt that they could finance the deal just through a certain amount of equity and then go to the senior debt for, let's say, 4 times EBITDA or cash flow. And probably in the last quarter, things have tightened up a little bit to the point where the buyer is still willing to pay the headline price that they had given us in the LOI, but the capital structure is changing a little bit so that the amount that the senior lenders are willing to give is about 3 times cash flow or EBITDA, and that requires them to either put in more equity on their own or to go to a mezzanine lender and fill that gap. You know, in a climate like this where an owner may be scratching their head about whether to rush to market or not, trying to wait and see if they're business is going to hold in through the next couple of quarters. It's a great time to check under the hood and see how things are going. One thing that we can't stress enough is make sure your financial statements are in great shape. Um, we've had a number of situations where the top line number looks great, but then you get into the company, we find that they're maybe not doing inventory accounting quite properly, and that impacts whether the true cost of goods sold would be, revenue recognition, whether that's being done properly or not. Are they reconciling their books on a monthly basis? There's a lot of things that are not that difficult, and particularly for a company that's got a good top line and good free cash flow. The investment that you can make in getting your books in order, so that when a buyer comes in and they give you the headline number and all the happy talks over, and they send in the folks to do a quote quality of earnings, uh, it will pay out in spades if you can have your books in as good a order as you can. If you're thinking about going into a sale in 2023, Q1, Q2, Q3, it's a good time to start assembling a team of folks to help you through it. My career has been spent primarily in investment banking and merger and acquisition work, but I did take a detour into the operating a business and a company that we grew to 90 million in revenues and decided to sell it. And at that point in time, my partners asked me, why can't you handle the sale? And I said, well, it's impossible to handle the complexities of a sale and still do what you're supposed to do on a day-to-day basis. And plus, the objectivity of having an advisor is invaluable. Beyond just having an M&A advisor, be looking for a good corporate attorney to help you get your records in shape. And of course, the CPA is always invaluable. Tax planning with your CPA to make sure that your company is in good shape for a transaction. And if there's some estate planning work you might want to do, that's important as well. So it's always good to try to get things in shape when it's kind of at a comfortable pace versus having to do it when you're in the middle of a transaction. One other thing about selling the business that I probably ought to mention is make sure you're doing a review of your current management team. Some of our clients look for situations where they can quote partner with a private equity, sell a certain percentage of it, sell control, but then remain very active in the business and partner with the private equity and take it to the next level over, say, another 4 or 5 years, and then sell it and get what we call a second bite of the apple. That happens sometimes, but most of our clients are looking for an exit where they are getting out of the day-to-day management of the business. And if you really want to make sure that the value of your business is maximized, make sure you got a good management team behind you, and that it's a team that the potential buyer can feel will help them take it to the next level. In some instances, you may need to be there for a transition for 3, 6, 9 months. Some buyers are comfortable, going out to find a new CEO to bring in during that time. But you certainly need to have at least a good number 2 or good solid management team beneath you.